Cloudflare just told the world it was cutting 1 in 5 of its workers. That same day, the stock crashed. By the closing bell, the price had lost nearly a quarter of its value. The same week, a payments company called BILL came out and said it was cutting an even bigger share of its workforce. The market loved it. Their stock went up. So which is it? Are layoffs good news or bad news? And how can the same kind of headline mean two completely different things to two different rooms in the same week? If you've been watching this earnings season and feeling something between relieved and a little nauseous, you're not alone. Let's decode this together. Here's what actually happened. Cloudflare reported its earnings last week, and the numbers themselves weren't really the problem. The problem was what came next. The company told Wall Street it expects revenue growth to slow down and that, to protect its profits, it would be letting go of about 20% of its workforce. Investors saw a company struggling to grow its way out, and the stock got punished. Hard. Then Bill stepped up to the same microphone and said something that sounded similar, but landed completely differently. They were cutting almost a third of their jobs to fatten margins, and the market sent the stock up. Same kind of news, same week, opposite reaction. If your stomach just dropped reading that, hold on to that feeling. It's the entire story. The reason this can happen comes down to one thing Wall Street cares about almost more than anything else, which is profit margin. Profit margin is just the slice of every dollar a company keeps after paying its costs. Workers are a cost. So, when a company announces layoffs, the math investors run is simple. Fewer workers means lower costs, which means a fatter margin. That's why a layoff announcement can pop a stock. The market isn't cheering the workers losing their jobs. The market is cheering the margin getting bigger. We know how absurd that sounds. Honestly, we had to read a few of these reactions 3 times to make sure they weren't satire. But this is the system, and the mechanism we want you to see clearly is this. The same investor pressure that rewards your retirement account when stocks go up is also pressuring companies to cut jobs to satisfy that account. The pressure is the villain here, not any one CEO. And right now, that pressure is squeezing tech, cloud software, payments, and ad tech especially hard. Here's where this gets close to home. Priya is 32 years old, a software engineer at a cloud company in Austin. She's been there almost 4 years. She's good at her job, her manager loves her, and right now, she's watching her company's stock climb after the leadership team announced what they called a workforce realignment. That's the corporate phrase. The honest version is that her department lost 12 people last quarter, and the rumor is another round is coming after the holidays. The thing eating at Priya isn't just the rumor. It's that the better the stock does, the more pressure there is to keep doing the thing that's making it go up. And the thing making it go up is firing people like her. This is the squeeze almost nobody talks about during a good earnings season. The same headline that makes your retirement account look healthier on paper can also be the one that lands a layoff letter on someone in your house. That's the answer to the question we opened with. Layoffs aren't simply good news or bad news. They're good news for one room and devastating in another. And those two rooms can sit inside the same building. Now let's translate this into Priya's actual life. She makes about $140,000 a year. On paper, that's a great salary. But Priya pays around $2,800 in rent every month. That's roughly a third of her take-home pay before she's bought a single bag of groceries. Add a car payment, the loan from grad school, the streaming subscriptions she keeps meaning to cancel, and she's realistically saving maybe $2,000 a month. If she loses her job, that whole stack, the apartment, the car, the savings runway, all of it, depends on how long she can keep paying the bills before the next paycheck shows up. Most tech severance packages give somewhere between 2 weeks and a few months of income. After that, the math gets ugly fast. So here's the action we want every household watching this to take this week. If your income depends on a tech salary or any salary in a sector where Wall Street is currently rewarding layoffs, build or protect a cash cushion equal to at least 1 month of your full expenses. Not 1 month of bills, 1 month of everything. Rent, food, gas, insurance, the works. That's the bare minimum. 3 months is better. 6 months is the kind of number that lets you say no to a bad next job because you don't need it tomorrow. 3 things we'll be watching as the next few weeks of earnings keep rolling in. The first is whether more cloud and software companies follow the same playbook. Guide revenue lower, announce layoffs, watch how the stock reacts. The pattern matters more than any single name. The second is how the broader tech labor market responds. Job postings for senior engineering roles are one of the cleanest signals you can check yourself in under 5 minutes right now. Open LinkedIn, search your role and your city, and see what the volume looks like compared to a few months ago. Third, whether this margin pressure starts spreading from tech into the sectors that sit right next to it, fintech, ad tech, anything that rhymes with software-ish. These stories tend to ripple outward, and we'll be keeping an eye on which industries get pulled in next. None of this is a forecast. It's just the part of the picture that most evening news segments tend to skip. The takeaway from this week is simple. Stock indexes and job security have stopped moving together, and in some sectors, they're now actively moving in opposite directions. That doesn't mean you should panic, and it doesn't mean every layoff headline is coming for your household. It does mean that when you see a stock pop on a layoff announcement, you're seeing a system that rewards margin over people. And the smartest thing any household can do in that environment is build a financial cushion that gives you breathing room if you end up on the wrong side of that math. Check your savings balance this week. Pull up your last 3 months of expenses. Do the math on how long you'd last if the paycheck stopped tomorrow. That number, more than your salary, more than your title, is the most important number in your financial life right now. Quick reminder, everything we cover on Decoded Money is for educational purposes only. None of this is financial advice, and we're not licensed financial advisors. Before you make any money moves, do your own research and talk to someone who knows your specific situation. If this was useful, hit subscribe. We do this every week. That's the Decode for this week. We'll see you in the next one.